Investment strategies, buy and hold. So I talked about this back in part two. Talked about how it's a risky strategy because um, trading you're not these are very volatile stocks. So if you buy and hold, it's not unusual to for stocks to crash. Is In fact, it's quite common on an annual basis for gold and silver miners to have some type of a sell-off during the year if you look historically. So um, if you're buy and hold, it's inevitable that you're going to go through periods of significant paper losses in your entire portfolio. So buy and hold it's a risky strategy. That's why I try to keep um, my cost basis down because I feel that the quality companies won't get as hit, is are more likely to come back. But it is risky. That's where the trading, if you do say 25 to 30 stocks and you're trading them and you're monitoring them and you're basically not allowing them to crash on you. Maybe you have some trailing stops on them, or um, it it allows you to hedge to a certain extent. Whereas buy and hold, it's much more difficult to hedge. Um, so one of the ways that I do that, I talked about my portfolio, my pyramid approach, where I try to keep, a strong base. That's one of the ways that you can diversify from this volatility. Okay, so using stops. So this is perhaps the ideal investment strategy for mining stocks because of their volatility. And it requires a lot of hands-on effort, a lot of monitoring, a lot of buying and selling. So you basically have to be a trader. So if you're using stops, if you have 30 stocks out there and you've basically put a stop, I don't know what you're going to use, 25, 30, 35% on them. I mean, it's possible to get stopped out. It's one of the reasons why I don't like to use stops, especially as many stocks as I have. I just don't want to get stopped out. But it is an ideal way to hedge your fund. And if you're trading, again, I think that's probably the ideal way to really to do mining stocks. But you have to be a good picker. You got to pick the right ones because it's hard to, if you're going to only have 25 or 30 stocks, it's going to be difficult to pick the big winners. Um, you have to determine your stop loss for each stock and be prepared for significant capital gains or losses whenever you have a stop loss, because that's going to be an event once, if you're going to trigger a sell stop, that's going to trigger a capital loss, capital gain situation. So you got to be aware of that. Using trailing stops can be very effective and lead to large gains because you effectively lock in gains once the stock trends higher. So I'm actually going to talk about trailing stops when I get to my exit strategy. But if you use trailing stops and let's say you have 25 to 30 stocks and let's say 10 of them are basically doing fantastically well, they're all up like 100%, then you can have like a 50% trailing loss on those and still have 50% gains locked in. It's a really good situation, if you will. It's kind of the ideal thing that you want if you're trading. And who knows how far up you can follow that stock or let it trend until it stops out. Okay, so part two. So cut your losses. So this is where you're using that trailing stop, and so whenever a stock trades down, it's going to get stopped out, and you have to decide if you want to get back into that stock, or you basically say, nope, that stock didn't work. I'm going to go find winners. I only want winners in my portfolio. That's sometimes some stocks you'll bring back in, some stocks you won't. Pressure winners. So this is when a stock is working. So let's say a stock, you put money in a stock and it goes up 25%, and you basically you double your cost basis into it. It's working. I'm going to press it. And then if it's a dog, it's like I'm going to sell it. So let's say If it goes down, you might have basically say, I'm only going to put a 10% stop loss on this company because I don't, um, maybe I'll keep it or maybe I'll just sell it kind of thing. Taking your profits. So this is kind of an ongoing thing. You have to determine, at what point do I want to take profits in companies? Do I want to just let them always run? Do I want to have an exit point for every stock? It's good to have exit points for your winners. So once you identify a winner, then you can identify an exit point, and the exit point can be anywhere from 100% to 1,000%. So you have to just decide, okay, this is, if I'm up 100%, you have to decide how much you're going to take off the table. Are you going to sell the whole thing, take half of it off, a third of it off, or are you going to let it run and then wait till it gets to 200% and take half of it off or something like that? You have to decide, what are your exit points for your winners. And you could also have exit points for losers as well. So it's up to you. Um, it's always good to keep part of a winner. I talk about this in my exit strategy. So keeping 25 or 50% and letting that ride and then using a trailing stop, you're basically locking in profits that way. It's a good methodology.